Corporate Finance Core, Topic 9, Financial Risk Management, Learning Objective number 4. We're going to understand how forward contracts can be used to hedge cash flows and earnings at risk. So, let's talk about a forward contract. A forward contract or forward contracts are obligations to buy or sell an asset at an agreed upon future time and place, quantity, quality, and price. And the price specified in that contract, we'll just call it the forward price. Now, a forward contract has two counterparties. One signs under where it says seller, and one is a buyer. So the seller of the contract delivers the asset and receives the forward price. And the buyer takes delivery and pays the forward price. So it's really just a bill of sale where everything's specified, but delivery happens later. Now, forward contracts generally have no upfront fees or costs. So you just find a counterparty and you agree upon it. And then at the maturity date, say we agree on a 1-year delivery of gold, you then meet at that time and figure out who pay the forward price and take delivery of the gold for the buyer and deliver the gold and take the money for the seller. Now, one thing that's kind of weird about forward contracts, we're going to talk about a little bit more, is because of the hassle of physical delivery, forward contracts can be structured to simply exchange cash based on the relationship between the forward price and the spot price, which is just the current price of the asset at delivery. So physical delivery is not necessary to actually hedge the risk. So we'll explore that idea later. It's really kind of a weird foreign concept, but you don't actually need to have a contract that specifies the delivery of gold to actually hedge the price of gold. So here's an example. Gold is selling for $1,200 today. We'll call that today's spot price. A miner enters into a forward contract to sell 100 ounces of gold at $1,200 1 year from now because she fears the price may decline. All right, so again, gold selling for $1,200 today. A miner's worried about that. She negotiates a forward price to sell 100 ounces 1 year from now at a forward price of $1,200. And she's doing this because what she really fears is a decline in gold prices to $1,000 per ounce. So let's think about cash flows if that $1,000 of ounce 1 year from now actually happens. So her worst fear comes true. Gold is only selling for $1,000 an ounce. So let's talk about her unhedged pre-tax cash flows are 100 ounces times $1,000 per ounce, so $100,000. Now remember, she was hoping or expecting that gold would sell for $1,200 next year. So she was hoping she'd make $120,000. But if gold's selling for $1,000 an ounce, she's only going to make $100,000, which is 20% less than expected. So if this contract, luckily she signed this contract that in which she is the seller, and she's going to deliver 100 ounces of gold for $1,200. So she just takes her gold, delivers it to the counterparty in the forward contract, the buyer, and that person pays her $120,000 for 100 ounces of gold. So she's completely hedged. She doesn't worry about the price of gold anymore. She has a forward contract to guarantee the price at $1,200. So she doesn't worry about the price of gold. She will just deliver it and receive her $1,200 an ounce. However, the contract could have specified that there's not a physical delivery of gold. There's just a cash settlement, an exchange of cash based on the relationship between the future price of gold, well, I should say the price of gold at maturity of the contract at delivery date, and the forward price that was negotiated up front. So we'll say the payoff for the seller, and this is the gold miner in this example, is the agreed upon forward price minus whatever the spot price is at maturity. So spot price just means the price for immediate exchange at the maturity of the contract 1 year from now. So you just take the difference between the forward price and the spot price times the contract specified quantity, 100 in this example, and that is the payoff to the seller. So what if this contract was set up to be a physical settlement contract, and the forward price is $1,200, quantity is 100 ounces, and at maturity, gold prices do fall to $1,000 an ounce. Well, I just take my payoff that's specified in the contract, my forward price of 1,200 minus my spot price of maturity of 1,000. You have to wait and see what that is. That's $200 times my $100 per ounce. I'm sorry, my 100 ounces quantity. That's $20,000. So the seller is just going to get a check for $20,000 at maturity from the buyer. So how does this help? Well, the seller now has a check for $20,000 and has 100 ounces of gold that she can now just sell on the spot market, which I said was $1,000. So she'll get her $100,000 for gold, just like she was unhedged. And then she has that $20,000 paycheck from our cash payment from the forward contract of $20,000. So she is whole. She's going to make $120,000. Now, what if gold prices fall to $500 an ounce? It doesn't matter. She'll sell her 100 ounces of gold at $500 and get $50,000. But she's going to get a $70,000 check in the forward contract. She will always make $120 as long as that counterparty pays the money, pays her that difference. Now, from the perspective of the buyer of the contract, we'd have a different formula. All you have to do is take the negative of that formula. Instead of forward price minus spot times quantity, we would just do spot minus forward times quantity. So let's assume that the Todd Hoffman is going to enter into a contract to sell 337.5 ounces of gold, which is actually his expected amount of gold, at $1,632 an ounce. Now, how would you get a forward contract? All you need to do is call a bunch of banks or commodity brokers and say, I'd like a forward contract to sell 100 ounce or 337.5 ounces of gold next year. Give me your best price. And if your best price was $1,632 an ounce, you just sign that contract and just wait around to see what gold prices are. One question comes up when hedging. A lot of companies, well, the risk minimizing hedge quantity is the expected quantity. So if you're trying to minimize the volatility of cash flows, what you want to do is just use your expected quantity as the forward contract quantity. However, companies will often use something less than that. It's called a hedge ratio or coverage ratio. And what that means, if I expect 337 ounces of gold, I may only enter into a forward contract to hedge 80% of that, so whatever 80% of 337 ounces is. And companies often do that because of the quantity risk, that they may not actually find the amount of gold, and they don't want to be stuck to having to buy the gold to deliver it. So how do we incorporate this new business model of hedging using forwards into the Todd Hoffman model? Well, I'm going to make an extra row in the income statement. That's going to be the derivative contract payoff. And I'm going to put in my formula. It's going to be the forward price minus whatever the spot price is next year times 337.5 ounces of gold. Assume they negotiate at 1632. I'll go to my spreadsheet and go to the scenarios tab. And what is that? B26. I'm going to say equals open 1632 is my forward price minus whatever the spot price of gold is, and I'll just point that to the expected spot price of gold in my spreadsheet, which is in B22. And the reason I'm doing that is I want to copy that formula over and see how this derivative will pay off based on different scenarios. And I multiply all that times 337.5 ounces of gold. So what you see is in the base case scenario, the expected gold price is the derivative payoff. That doesn't always have to be the case, because the forward contract, you may not get a best price of 1632, maybe it's 1630. However, now when I copy this across through row column G, what you see is every time gold prices fall, you get paid. Todd Hoffman gets paid. Every time gold prices go up, Todd has to pay. And you can see that's what's happening. Now, if I do my data table, if I look at my data table, notice that revenues, EBITDA, and free cash flow are always the exact same values, no matter if gold is plus or minus any percent, because anytime gold varies from that forward price, Todd gets Todd gets paid or will pay, and Todd no longer has exposure to gold. Todd still has exposure to, say, content of gold, the amount of gold, so you can see that in the second data table, but holding gold quantity constant, it doesn't matter what happens to gold prices. Todd is hedged. So you can see that by looking at the risk measures before and after the hedge. So unhedged, you can kind of see the exposures are plus or minus 20% of gold prices. However, once we put on the hedge and model that in our spreadsheet, you can see Todd is no longer exposed to gold prices. There is no longer a break-even depreciation of gold because he no longer worries about depreciation of gold, and the earnings at risk goes to zero because he's the value at risk, the value of gold that's subject to price risk is zero. So in this topic, we understood how forward contracts be used to hedge cash flow and earnings risk, and we used an example of a company that has revenue risk. So they enter into a contract to sell